The Minnesota Office of the State Auditor presents How to Monitor the 6-Year Rule. This video is a follow-up to our video titled The 6-Year Rule. If you've not already watched that video, we recommend you do so before continuing. In this video, we will identify steps you can follow to monitor compliance with the 6-Year Rule and point to a helpful tool available on our website. In order to monitor compliance, the first step is to identify key dates. The first is the district's certification date. It'll allow you to determine the 5-year rule date. The certification date is the date the district's original value is certified by the county auditor. Do not confuse this with either the TIF plan approval date or the date the authority requested certification of the district. The 5-year rule date is 5 years from the certification date. For example, a district certified July 10th, 2014 would have a 5-year rule date of July 10th, 2019. There are, however, some statutory extensions of the 5-year period for some districts certified during date ranges related to the Great Recession and the COVID pandemic, where the 5-year period may run for 8 or 10 years. In addition, some authorities have obtained special law extensions of varying lengths for districts with special situations. So you should note whether any extension applies to the district and identify the 5-year rule date accordingly. In the TIF annual reporting form for each district, on line 11 of the Overview tab, we populate the date that we are tracking for the 5-year rule date for the district. The 5-year rule date will be used to identify which costs and obligations are considered in-district or out-district. And of course, the 5-year rule date also allows you to identify the 6th year, which is the calendar year following the 5-year rule date. For example, if the 5-year rule date was July 10th, 2019, year 6 would be 2020. Again, make sure to note any 5-year rule extensions and understand that year 6 might be year 11 or 9 or some other year. You'll need to know year 6 as the year to start making annual determinations as to whether decertification or parcel removals are required. The remainder of the steps here only become relevant once you reach year 6. The next 5 steps relate to the formula in paragraph A of the 6-year rule statute that identifies when decertification is required, or at least when it is provisionally required before a deferral for a PAYGO might apply. To recap from the earlier video, decertification is required when the product of the applicable in-district percentage multiplied by the cumulative tax increment revenues equals or exceeds the amount sufficient to pay in-district obligations excluding pay-as-you-go notes. In year 6, both the applicable in-district percentage and the amount sufficient to pay in-district obligations will largely be known, so you can start to monitor the revenue benchmark, or the total cumulative tax increment revenues that trigger the decertification requirement when reached. The benchmark equals the total in-district obligations excluding PAYGOs divided by the applicable in-district percentage. Steps 2 and 3 are to identify the in-district obligations and the applicable in-district percentage, so we can compute the benchmark in step 4. And to allay any immediate confusion or alarm you might be having if you only have a PAYGO obligation, yes, this will compute to 0 and mean decertification will be required under paragraph A right away in year 6. But the deferral of that requirement will apply under paragraph B of the statute, as we'll see in step 7. Step 2 is to identify the amount sufficient to pay in-district costs and obligations. As of year 6, you should largely be able to identify in-district and out-district expenditures. In-district costs and obligations are those which are for activity that is both located in the district and which meets the 5-year rule. Generally, in-district costs and obligations include direct expenditures made to a third party by the 5-year rule date, bonds that were issued and their proceeds largely spent by the 5-year rule date, binding contracts that were entered into for the performance of activity by the 5-year rule date, loans or payments to reimburse costs that were paid by the 5-year rule date, and expenditures for qualifying housing purposes. To be clear, expenditures or obligations for activities located outside of a TIF district do not become in-district costs or obligations by meeting the timing of the 5-year rule. It only works to deem costs that are for activities located within the district to instead be considered out-district if they occur after the 5-year period. It may also be wise to refer to the 5-year rule statute and be sure to get legal advice to clarify any potential nuances or questions as to whether obligations or expenditures meet the 5-year rule. Out-district costs and obligations, therefore, are those which are for activity that is located outside the district or is located in the district but didn't meet the 5-year rule. Administrative expenses, which don't really have a location, are defined as out-district costs. There is one rare exception where administrative expenses are considered in-district costs that we'll discuss in Step 4. Once you've identified which costs and obligations are in-district versus out-district, identify the sum of all in-district expenditures and obligations, excluding any PAYGO obligations. I'll use the amounts from our example in the previous video throughout this video. We start with the total increment that will be spent to pay all in-district costs and obligations. Then subtract the amount that will pay any qualifying or in-district PAYGO notes, to get to the total excluding the PAYGO obligations. We've said these amounts should largely be set as of year 6, but note that the ultimate amount of interest may still be a bit of a variable for some obligations, so you'll want to update your tracking of this amount every year. Now we aren't quite done here because while we've identified the in-district costs and obligations excluding PAYGOs, we actually need to identify the amount sufficient to pay these in-district costs and obligations. And one possible variable here is if there are other revenues that may be reducing what is needed to be paid from our measure of cumulative tax increment revenues. So if obligations are also being paid with non-increment sources, like special assessments for example, you need to subtract those amounts. When we get to Step 5 and talk about identifying cumulative tax increment revenues, we'll see that the measure of cumulative increment revenues only includes increment generated by the captured value, but there are other revenues that get defined as tax increment in statute, like interest earned on increment balances, lease and sale proceeds of properties purchased with increment, etc. As these other increment revenues are also used to pay in-district obligations, they should also be subtracted here to identify the remaining amount of in-district obligations for which cumulative increment revenues generated by captured value will be sufficient to pay. These subtractions can be another variable from year to year that makes the calculation not completely known as of year 6. For our example, we'll keep it simple and assume no other revenues were used to reduce the in-district obligations. Step 3 is to identify the applicable in-district percentage that applies to your district. The standard in-district percentages are 75% for redevelopment districts and 80% for all other types of TIF districts. There is a statutory provision, however, that allows an election to be included in the TIF plan to allow pooling an extra 10% for certain affordable housing purposes. When used, the applicable in-district percentages drop to 65% for redevelopment districts and 70% for other district types. Step 4 then is to calculate the revenue benchmark to help you plan for when decertification or parcel removals may be required. In our example, we identify $400,000 of in-district obligations, excluding the $225,000 PAYGO, and we had an applicable in-district percentage of 75%. So the revenue benchmark equals $533,333. If we look at this in year 6, which we'll say is 2025 for this district, and we've collected $398,400 through 2025, and we're receiving about $66,400 of increment every year, we can project out when we are likely to reach the benchmark. Here we see it looks like it'll be very close in 2027, and the benchmark could be met that year if increment collection increases. Otherwise, it looks like the benchmark will be reached in 2028. Once revenues hit that point, it'll be time to decertify under Paragraph A, but that decertification will be deferred due to the PAYGO not terminating until a later date. If there was no PAYGO and the bond were the only in-district obligation, that would be the time to decertify. But because of the deferral for the PAYGO, this is the time to assess where the parcel removals are required. For most districts, this is the end of Step 4, and you can skip ahead to Step 5. But for those districts that have an election in the TIF plan to allow additional pooling for housing, there are some additional considerations. If aside from admin expenses, there's a mix of pooling for other purposes along with pooling for the affordable housing purposes, there's no dramatic change. It's just that the applicable in-district percentage will be smaller, as we noted earlier, which in turn affects the calculated benchmark. If all pooling, aside from admin expenses, is for affordable housing purposes, then admin expenses get treated as in-district costs. And that means we need to determine the amount sufficient to pay in-district obligations, excluding PAYGOs, to be an amount that includes admin expenses. Unlike the other in-district costs and obligations, however, the ultimate amount of admin expenses is not likely to be established as of year 6. So this process of estimating the revenue benchmark will likely be more variable and less reliable. We can identify three possible options to identify how much admin costs to include in the amount sufficient to pay in-district obligations. First, you can assume that admin expenses will be maxed out to 10% of total expenses, and you can impute the amount. If admin expenses will be 10%, and admin expenses combined with the other in-district costs and obligations, excluding PAYGOs, will be 65%, then the previously identified in-district costs will be 55%. So in our example, if we divide the $400,000 by 55%, we can get a new total of $727,273. And we multiply that by 10% to get $72,727 of admin costs that get us to a new total of in-district costs and obligations of $472,727. The only caution with this approach is that if the total admin costs end up being less, there may be a need to return surplus increment. Returning surplus increment is considered an in-district use to make sure that at least 65% ends up being used for in-district activity. But this is a bit of a digression into complying with the overall pooling limit. So a second approach, if you do not believe a full 10% will be used for admin costs, is just to estimate the total amount of admin costs to include in the amount sufficient to pay in-district costs. Here we'll estimate $55,000 of total admin costs for a total in-district measure of $455,000, which leads us to an estimated revenue benchmark of $700,000. This estimate can be adjusted each year as you go along. And a third approach is just to use the known admin costs to date and update it each year. This might make the revenue benchmark a little less reliable and cause more variability each year, but it could be a workable approach if you understand that. And again, these complexities rarely apply, so step 4 should be much more straightforward for most districts. Okay, so in step 4, we identified the revenue benchmark for planning purposes to look ahead at when decertification or parcel removals will be required. And planning ahead is good. But the formula in paragraph A, the actual requirement, is to multiply the applicable in-district percentage by the cumulative tax increment revenues to see if that amount exceeds the amount sufficient to pay in-district obligations, excluding PAYGOs. So making this determination will be step 6. But first we must identify the cumulative tax increment revenues, and this is step 5. In the previous video, we identified the details of what is included in the measure of cumulative tax increment revenues. To refresh, we'll look at the revenues reported on the annual reporting form. Cumulative tax increment revenues include the tax increment revenues distributed from the county, and include the subsequent January settlement distribution, if any, if not already included, and also include reimbursements of TIF credits, but do not include the other revenues that are also identified as tax increment. As we noted in step 2, those other defined increment revenues might be getting used to pay obligations and might reduce the amount that will be sufficient to pay obligations, but the measure of cumulative revenues in the formula just looks at tax increment generated from captured value and not these other increment revenues. The included amounts are shown here as lines A and B, but there are a couple of subtractions to identify, shown as lines C and D. These are typically and hopefully zero, but they do sometimes apply, especially line C, which is any return of excess increments. This is what is formally identified as excess increment on the EIC tab of your annual reporting form because it has been received in excess of what the TIF plan authorizes. This does not include the voluntary return of surplus or unneeded increment. As for line D, identify any return of increments made to remedy improper receipt of increment. This does not include remedies for improper expenditure of increments. From our running example, we'll evaluate this using our 2028 amounts. The total here of A plus B minus C minus D is the measure of properly received and usable increments generated from the captured value in the TIF district. Step 6 is to make the annual final analysis of whether the trigger to decertify under paragraph A has been reached, again notwithstanding a deferral under paragraph B, which will be the subject of step 7. 75% of cumulative revenues in this example equals $448,200. Which is indeed greater than the amount sufficient to pay in-district obligations, excluding PAYGOs. So decertification under this paragraph is required in 2028 for our example. And we now turn to step 7, to evaluate whether a deferral applies. We first ask ourselves, A, is there a qualifying PAYGO that remains outstanding after the end of the year? Remember, we're talking about qualifying or in-district pay-goes. Pay-goes associated with out-district activity don't cause a deferral. If the answer is yes, then a deferral applies and you can go to step 8 to determine if a parcel removal may be required. If the answer is no, there are a couple more questions and you can proceed to step 7b. In our running example, we reach the trigger in step 6 in 2028 and the pay-go terminates in 2040. So for years 2028 to 2039, the answer will be yes. In year 2040, the answer will be no. So in each of these years where you would conclude yes that the deferral would apply, you would proceed to step 8. In 2040, or when the answer is no, then we go to step 7b to ask the next question. For step 7b, we ask, was there previously a deferral due to a pay-go? If yes, then proceed to step 7c. If no, which would be the case if a district either did not have any qualifying pay-goes or did, but they were paid off or terminated prior to reaching the trigger for decertification under paragraph A, then you could conclude that a deferral does not apply and decertification of the district is required. In our example, the deferral had applied prior to 2040, so we proceed to step 7c. For step 7c, we ask, is there another in-district obligation that remains outstanding? If yes, then proceed to step 7d. If no, which would be the case if the qualifying pay-go was the last remaining in-district obligation, then you can conclude that a deferral does not apply and decertification of the district is required. In our example, this was the case, and so our example district must decertify at the end of 2040. And because we know this early in 2040, it is best to do this and communicate it to the county auditor as early as possible and not wait until the deadline of December 31st. But for a district where the answer is yes and there is another in-district obligation, let's check out step 7d. For step 7d, we ask, is the applicable in-district percentage of cumulative revenues sufficient to pay the remaining in-district obligations? You might wonder if this was already answered affirmatively in step 6, but step 6 did not evaluate whether there was enough increment to cover all in-district obligations, both pay-goes and other obligations. It only looked at if there was enough to pay the other in-district obligations. And while we had said yes, that doesn't mean that increments were used to pay those obligations first before paying pay-go obligations. So when the pay-go is paid and no longer outstanding, those other obligations may still have outstanding amounts, and the deferral should continue until this question can again be answered in the affirmative. So if yes, then you can conclude that a deferral does not apply and decertification of the district is required. If no, then the deferral continues. This brings us to step 8, determining if a parcel removal is required. Remember, this step will be evaluated beginning when the trigger in step 6 is reached, and this must be annually evaluated concurrently with step 7. Are there any parcels in the district where increment from those parcels is not obligated on any outstanding in-district obligation? Perhaps they never were obligated to an obligation and have to be removed in year 6, or perhaps they had been obligated but those obligations were paid off. In our example, this became true in 2031 for parcels 2 to 7, when the bond was paid off and these parcels were not pledged on the outstanding pay-go, and parcel removal would have been required in 2031, if not for the fact that our district precedes the effective date of the removal requirement. But as we examined in the prior video, parcel removal at that point, or actually a couple of years earlier, would still be wise. So we encourage making this evaluation even for districts that precede the effective date of the requirement. Lastly, on the OSA website, we offer a sample spreadsheet tool that you can use to aid in your tracking or monitoring as suggested in this video. Please note, however, that this tool is not meant to substitute for legal advice, nor does it guarantee compliance. It is offered merely as a starting point for following the steps suggested in this video. You can find the tool linked, among other spots, on the web page for this video, which you can find on our website under the Training Videos link, under the Training and Guidance menu. From the list of videos that come up, find and click on this title to get to that page. And that concludes this video on how to monitor the 6-year rule. Please again refer to the additional resources noted here. Aside from the statute, these can all be found on our website, www.osa.state.mn.us. Thanks for watching.